Well, Redefine International has reported a 30% increase in full-year earnings available for distribution of £39 million. The company says activity in the retail and commercial sectors has improved despite slow growth in the Eurozone economy. Joining me now from Cape Town is Evan Robbins, Head of Listed Property at Old Mutual Investment Group, MacroSolutions. Good to have you with us today, Evan. Maybe a moment ago you did hear me speaking to Mia about the results coming out from Redefine, and she mentions significant restructuring, but this has really had a significant impact to a positive effect, rather, on the company's results. Your analysis of the numbers?
Yes, what was very pleasing is that NAV increased a healthy amount despite the internalisation of the Manco. They issued shares as payment to the Manco owners. Now that they have got no Manco and they're turning managed, improves the investment proposition of this fund tremendously, because one would prefer not to be invested in a company with a management company because it creates a conflict of interest. So they managed to remove that problem, and they're still being able to show NAV growth despite the dilution from that transaction.
The capital raising initiatives that they've had in the past, has this also worked to their benefit?
Well, the share price has been weak since the last capital raising. So they still haven't deployed all the cash. So of course, some of the cash is sitting on their balance sheet, earning or in pounds, actually nothing, even though the shares have been issued. So we'll only see the benefits of some of that cash being utilised when they can make good investments with that, and shareholders can reap the benefits from those investments.
Let's touch on that cash. It does seem as though they do have quite a bit of it on their hands at the moment, so much so that they're looking to also issue out a second dividend. Are you concerned at that maybe they're very bullish on the dividend and not necessarily allocating it again to capital expenditure?
I think they've got plans. They have got a pipeline of some projects they're busy with, and they hinted that there's even more things that they would like to possibly do. So I think they've got a growth path in their mind, and it's just a matter of time before they utilise their cash.
Tell us about this growth path, Evan, from your analysis. When you compare Redefine International with its market competitors, what opportunities of value can they find in the Eurozone region?
The Eurozone region is pretty competitive, so it's not easy for them to find more attractive propositions than many others. They do have quite a few opportunities within their portfolio, especially some of the retail they have in Europe and Germany, where they can do expansions and they can bring in some plans to bring in some very, very sought after tenants into some of their shopping centres, which is likely to enhance the whole shopping centre and increase valuation. So they do have some unique projects there, but in terms of acquisitions, there's no reason besides their contacts why they should be able to make better acquisitions than anybody else.
Are there any other areas of growth which you wish you could whisper into Stephen's ear?
I think they're already in Germany, and they did mention they find their market attractive, and I think their market is attractive. So if they can find some good opportunities there, a lot of their assets seem to have long lease expiry profiles, which is positive because Europe at the moment is not in a good place. But if you've got a long lease expiry profile, you don't really have to be that concerned about the short term. You can have a longer term view.
The mix in Germany and their entrance into that market, does this also differ to what their competitors are doing?
Well, they've been in Germany for some time, and some of the other competitors in terms of foreign companies listed on the JSE as well are also in Germany. So I think they have got a foothold already, and they've got expertise on the ground already, which I look to be increasing. So I think they have an advantage there. But I think for many people, the German market is an attractive market, especially between the cost of funding and the yield you can get on the properties. The big concern in Germany, of course, is when those leases come up renewal, if you can let them and what rates you're going to get. You're working in a very low inflation environment, which is very different to the environment we're used to in South Africa. So your outlook for growth in rentals going forward is much more subdued.
Just on that, the Australian market, is that also a competitive one that they're trying to get in onto? The likes of Growthpoint are already there.
What is quite interesting is they seem to be exiting the Australian market. They reduced their stake in Cromwell, which is their exposure to the Australian market, and they suggested in results that there are tax issues, but they may very well look to reducing that whole stake if they can find other opportunities in Germany or elsewhere to utilise the cash better in, And in their strategy, they actually outlined quite a clear strategy in terms of where they want to be focused on, and Australia was not an area where they're looking to focus on.